Let's start by looking at operating ratios or profitability ratios. These are measures of the effectiveness of our sales and expense management. The two that we're going to look at are return on sales, also known as profit margin, and average, also known as effective tax rate. Profit margin is a measure of net income divided by net sales. This provides information on a company's ability to generate and market profitable products, as well as control its costs. What this ratio tells us is the number of cents in profit for every dollar of sales. So the higher, the better. Now, average or effective tax rate is tax expense divided by pre-tax income. This provides information on the company's ability to manage its tax costs. The lower, the better. Next, let's look at investing ratios. Now, investing decisions, remember, involve investing money in assets, usually in the form of working capital and fixed assets. The related ratios then measure how effectively we are at managing these assets. Now, the first investing ratio is the asset turnover ratio, which is an activity ratio, and all of these next ratios we're going to look at are just different subsets of the asset turnover ratio, so therefore they're all activity ratios as well. Now, the asset turnover ratio measures net sales divided by average total assets, which tells us the speed at which our assets are used in operations. Said another way, it's the sales dollars generated by a dollar of assets invested in our business. So the higher the ratio, the better. It's showing how efficient we are at generating sales from our invested assets. Fixed asset turnover is a ratio of sales to average fixed assets. This indicates the speed in which our fixed assets are used up, or again, said another way, it's the sales dollars generated by every dollar of fixed assets. The higher the ratio, the better. It means we're using our fixed assets more efficiently. Next, let's look at accounts receivable turnover, which is the first of the three working capital turnover ratios. Accounts receivable turnover is credit sales divided by average accounts receivable. Now, when you don't have credit sales, which you won't always have, for instance, if you're calculating ratios off of someone's 10K or 10Q or their public filing or their financial statements, you won't necessarily have what their credit sales are. So you can just take total sales in that case. And it's still going to be a good measure, particularly when you're measuring year to year or looking across companies, because you're measuring it in the same method, apples to apples ratio, and that's the most important thing. Now, this indicates the number of times the receivables are recorded, collected, and then recorded again. Or in other words, the number of times our AR balance is collected in a year on average. Now, the higher the number is better. It means you're collecting your accounts receivable faster. Inventory turnover is a ratio of cost of goods sold to average inventory. This tells us the number of times our inventory is replaced in a year. The higher is better. This means you don't have inventory sitting around, but this ratio is going to vary drastically depending on the industry you're in. For instance, Boeing may only produce a plane or two or 5, I'm not sure, however many a year. It's a low number compared to, you think of like Apple, who produces so many iPods and sells those. They're going to be turning their inventory a lot faster. Now, accounts payable turnover is the last one. It's cost of goods sold divided by average accounts payable. This is the extent accounts payable is used to finance inventory. This measures the extent to which we are essentially financing our inventory. So the lower is better, which means you're holding your payables longer. Generally, you want this to be at least what your accounts receivable turnover ratio is, since you use the money that you collect from your customers to pay down your accounts payable. Now, each of these turnover ratios, as well as the fixed asset ratio and the total asset ratio, can be divided into 365 days to give you a day's measure. So, for example, if our accounts receivable, we knew it turned over 12 times each year, and we divided that into 365, that would tell us that on average, we have about 30 days of accounts receivable on hand, or 30 days of sales, on hand. What that means is we're probably selling to our customers somewhere around 30 days terms and allowing our customers to pay us in about 30 days time. Now let's look at the next investing section, which is solvency ratios. These are used to assess the company's ability to meet debt payments. So for example, our current ratio takes current assets divided by current liabilities. This is the ability to pay current debts using current assets. you generally want this to be a higher number, but not too high. Because the higher the number is, means the more current assets you have. For example, it could be cash, and if you have a lot of cash sitting around, it's not invested in your business working for you. And so you don't want this ratio to necessarily be too high. The quick ratio is just a spin on the current asset ratio. It's just taking a select amount of assets, called quick assets, and dividing those by current liabilities. By quick assets, what we mean are cash, marketable securities, and accounts receivable. This tells the ability to pay our current debts quickly, so with those quick assets that are just much more liquid. The last ratios we have are the financing ratios. First of which is the capital structure leverage. This is a ratio of average total assets to average stockholders' equity. This measures the extent to which a company relies on borrowings or liabilities. With no liabilities, this ratio is 1. Because keep in mind, assets equals liabilities plus owner's equity. So if you've got 0 liabilities, you've got the same number of assets as the equity. Now, as liabilities increase, this ratio increases. So as we discussed in Module 5, some debt's typically good for a business, but you don't want this ratio to be too high. Next, debt to equity is a ratio of average total liabilities to average common equity. Another way to measure capital structure leverage is through this debt to equity ratio. The higher the debt, the higher the ratio, but again, you don't want this to be too high. The interest coverage ratio is the last ratio we'll look at for financing. This is income before taxes and interest. So it's pre-tax income and pre-interest income, and you divide that by your interest expense. What this is telling us is our ability to meet our interest payments. The higher the number is better.